Okay, let's get started. Hello, and welcome to the brave new world of investing in 2026. I think the year-to-date price action already illustrates rather neatly the two deeply conflicting forces which seem to be at work. On the one hand, there's this sort of desperate desire to rally, which you can see the whole time in equities and credit, and which is broadly consistent with ongoing growth, high levels of corporate profits, and just business as usual. And yet, on the other, we can see that they're both being completely eclipsed by the rally in gold, which is perhaps more consistent with the massive geopolitical turmoil which has been on display at Davos again this week. And to my mind, the main challenge for investors in 2026 is to understand what lies behind these two conflicting forces and to try to reconcile and navigate them. And that's what I'm going to try and do today. So to do that, I've divided my presentation into three. First, we're going to look at what I think everyone knows, namely that high returns have left a great many assets looking expensive, and we're going to see whether we can really just explain that in terms of a strong global economy. I'm going to argue that regime change risk is basically everywhere, and yet is something markets always struggle to price. Then we'll go on and look at what I think has really been making assets expensive, namely money creation and money flows. And we're going to assess the likelihood that we get even more of these money flows, especially in the early part of this year. And I'm going to argue that although policymakers can always pump more money in, they can't actually control where it then goes. And then finally, we'll look at what investors can and should do about this, from govies to risk assets to vol to precious metals. But if there's one thing I hope I can achieve in the next 30 minutes or so, it's to convince you that there's this disconnect between the risks which are all too visible in the political arena and then what's being priced into markets. It's never easy or straightforward, but I do think there are better and worse ways to position given these underpriced risks. If you like, it's just a question of cheap convexity, and which are basically the equivalent of still watching the show, but being seated by the exits. Because the longer this show of asset price inflation goes on, the greater is the likelihood that what started out by being good investments at some point turn bad. So, to begin with, let's try and understand what drove asset returns in 2025. Clearly, 2025 was one of those years everyone in markets loves because almost everything went up. Equities rallied, credit rallied, hedge funds rallied. About the only things that didn't rally were Bitcoin and oil, and I'm going to come back to Bitcoin in a minute. But the standard story that you see in most people's outlooks is that the reason this happened is because the world economy proved resilient to tariffs, inflation continued to fall, and therefore everyone says markets rallied back strongly following the original Liberation Day shock. And people tend to say also that it probably helped that the tariffs ended up being lower in practice than everyone feared when they were first announced on Liberation Day. And that's all true, and expectations for growth and inflation in 2026 remain broadly optimistic, and I don't necessarily disagree with them, but I don't think that's a good explanation for what we actually saw in markets, for what was actually driving the markets. And that's a big problem because it's that same idea of economic resilience, which is the main reason most people give for being optimistic about further gains in markets in 2026. And in fact, it's pretty easy to pick holes in that argument that fundamentals are driving everything, if only you examine the market performance in a bit more detail. I think there are three problems which are really important. So, big problem number one is that when you look at the market returns across the board, it kind of feels more like a debasement trade than an economic growth trade. Yes, everything went up, but gold and silver went up way more than almost anything else, and the dollar depreciated by euro and Swissies by about 14% or so. So if you look from a global or a non-US perspective, a large proportion of all these positive returns on global and US assets they basically disappear. You could have matched the return on the S&P by sticking your money in a euro deposit account, never mind if you'd actually gone and bought non-US equities or gold. So it's more a debasement trade than anything else. Second problem, not only is debasement a better description for the high absolute returns than fundamentals, but even if we look at the relative returns, they've got much more to do with money flows than they have with fundamentals. And you can see this if you break down the equity return into the proportion from earnings and the proportion from the change in PE. I've left off the dividends just for simplicity. This pattern isn't particularly surprising. You often find it, but still, FTSE and Eurostoxx were some of the better performing major indices, despite having barely any earnings growth. Here I've used trailing earnings growth, but even if you look at forward expectations, you still come to this same broad conclusion. Conversely, some of the best performers like Japan and Korea did have positive earnings growth, but it wasn't really that drove the bulk of the total return. It was the revaluation as money flows poured in. And as I said, that's quite a common pattern, but it's still important that the money flow ends up outweighing the fundamentals. Maybe it's a bit clearer with something like Bitcoin. In theory, if Bitcoin has got fundamentals, you would have said they were all positive last year with the Genius Act and the US doing everything it can to make crypto investment mainstream. And yet, late in the year, when we started having outflows, that ended up dominating the price action and created a loss for the year as a whole. So fundamentals are certainly one of the factors that drive fund flows, but they're far from the only one. And if we want to understand what markets are doing, we really need to understand those flows. I'm going to have a lot more to say about that in the second part of the presentation. For now, though, there's a third problem with the fundamental narrative, and it's a bit more subtle than the other two, but in some ways it's the most important. If you think it's robust fundamentals, which have generated all the strong returns, then you're more likely to extrapolate those returns into the future, and you may end up underestimating important sources of vulnerability. Let me explain a bit further. These are actually some of my favorite charts in the whole presentation. So there's something a bit weird at the moment where geopolitics is obviously in turmoil. Everyone keeps referring to how uncertain everything is. They can't even predict where tariffs are going to be at the end of next week, never mind at the end of the year. And everyone keeps saying everything is unprecedented, and with good reason. And yet, when you look at the dispersion of forecasts for growth, or you look at the dispersion of forecasts for earnings on most major companies, especially in the West, what used to be called the West, what you see is they're more clustered than ever before. There's less dispersion in US growth forecasts than at any point over the last 35 years. There's less dispersion in these earnings forecasts for at least 5 years, if not longer still. And I think we've got to ask why. Some of it is that, of course, people's modal forecasts for the most likely outcome, it's kind of the idea that nobody ever predicts the recession. The modal forecast is always going to understate the risks. If you ask 100 people for their most likely scenario, of course you're going to get something much more clustered than if you ask one person for 100 different scenarios. And some of what's happening is people having to consider extreme scenarios. But you can see it's more than that. Because in the past, if we look at gauges like the number of references to uncertainty in the news, those did broadly correlate with the dispersion of growth expectations, those consensus forecasts for growth, and yet now that relationship is broken down completely. I think we've got to ask why, and I don't think it's because of a problem with the gauges for uncertainty. Again, there's something quite subtle going on here. Often people look at the extreme valuations and they say, oh, the markets are really complacent, or markets aren't reflecting the fundamentals. But it's a bit more complicated than that. There are certainly times in the past, like early 2020, when I would have been very happy to say that investors were complacent, when corporate leverage was high and yet credit spreads were really low, for example, or when equity valuations were high and yet corporate earnings looked vulnerable. At the moment, though, you can't say that. At the moment, corporate earnings are fantastic, especially on US tech, but even more broadly, profit margins are at high, corporate leverage is close to all-time lows. You can point to individual pockets in private equity-owned companies or private credit and point to the vulnerabilities, and I did a presentation on some of those last year. But it's really tough to say that the valuations are simply detached from fundamental reality. What I think you can say, though, is that those extraordinary profit levels themselves reflect an unusual dynamic, and that dynamic is potentially more vulnerable to abrupt change than is widely recognized, and certainly than is reflected in the valuations. Again, let me explain. So, one obvious factor is simply the K-shaped economy. As many people have noted, inequality is at highs, especially in the US, and the economy is being disproportionately driven by spending by the wealthy. I'm not sure I entirely believe the Moody's estimate where they say that the wealthiest 10% are responsible for fully 50% of US consumer spending, but even if the level isn't quite right, that's the right story, definitely, the general tendency. And what that in turn means is that continuing wealth gains are the major driver of future spending. And if anything happened which turned those wealth gains into wealth losses, then the whole outlook could change more suddenly than it would have done if we didn't have the underlying K-shaped economy, more suddenly than if growth were more evenly supported. And we usually think of leverage in terms of debt, and certainly that's an amplifier. But in a broader sense, leverage is really just sensitivity to asset prices. And if you think in those terms, you can see where the vulnerability might come from. Even in Japan at the moment, the level of financialization means that the stock market is worth more relative to GDP than it was at the height of the bubble in 1990. That's not true for real estate, but it is for stocks. In the US, where stocks, of course, are more important, then we are now well beyond the heights that we had in the dot-com bubble, even if you just look at listed equities, and especially if you include privately owned companies, we're at almost double those levels. So for me, what that means is there's already this strong element of circularity that comes from the importance of wealth effects. Provided everything keeps on going up and wealth keeps rising, then it all feels very sustainable. But if at some point asset valuations start falling for whatever reason, then that sensitivity starts working in reverse. There's another reason why I think profitability and market dynamics are potentially nonlinear, though, and that's the risk of regime change. And in some cases, geopolitics makes this completely obvious, as we've already seen year to date. If you are holding Venezuelan bonds or even Greenland bank equities, then you're prone to these violent lurches based on, have you had a sudden change in government? Has the US invaded? And in these cases, the market's actually interpreted that possibility as being positive, but that needn't always be the case. Likewise, here I've picked on Ørsted as an example, where, again, what did you see over the last year or two? It's that the sudden shifts in US policy, changing the goalposts, were directly responsible for sudden drops in earnings expectations and ultimately for them going out and raising equity and sending the stock price down. So far, markets are mostly treating these sorts of risks as idiosyncratic and just affecting one or two companies in specific sectors or geographies. I think you can make a strong case that sort of regime change risk is now everywhere. So look at what the proposals for caps on credit card charges have suddenly done to US bank equity prices over the last week or two. Think of the potential for sectors other than defense to suffer dividend bans or tariff changes or suddenly be subjected to massive lawsuits. And a lot of this, yes, is Trump changing the rules at a moment's notice, but it's not just that. I did a piece last year based on Cory Doctorow's excellent book on enshrittification and the way that big US tech companies in particular have been able to build moats around their earnings, not only through technological superiority and network effects, which are important, but also through effectively regulatory capture and effectively running monopolies. And while on the one hand, those advantages that megacaps have, especially in the US, they make it very hard for any other newcomer to break in and gain market share. On the other hand, they also make these companies unusually vulnerable to sudden changes in the regulatory regime, whether that's antitrust and breakup, or even things like tax changes coming from other jurisdictions. And I think that's exactly why you see spending on lobbying by the big US tech sector going through the roof. It's also why the tech companies and the US government are so unusually fussed about things like EU regulation. Now, the EU itself, as we know, moves super slowly, but the more stressed the geopolitical environment becomes, the more likely it is that we see that sort of sudden, abrupt change affecting individual companies or even affecting markets. If you go back to my box plot a few slides ago, or with earnings expectations being clustered, I said it's in the West that that's the case, and actually some of the exceptions are companies like Alibaba, where investors have come face to face with what those sort of regime change or regulatory changes can do in practice, and overnight, if the government changes its tune, your entire business model needs to change. To my mind, that sort of risk is now everywhere. Even before we come to the quite serious suggestions that AI is on the verge of removing a massive chunk of jobs from the economy. You've got these legal, political, and technological risks everywhere. Now, I say everywhere apart from asset price levels. Because what's remarkable is when you start thinking about these regime change risks, and then you come back to all these market valuations. Risk premia everywhere are close to rock bottom. It's only in govies that term premia are beginning to increase, and many people would say with good reason. Everything else at first sight just looks as though it's pricing in the most optimistic scenario possible, where AI improves productivity and profits, even though we're starting from record levels, and where all the geopolitical and the bubble risk can simply be completely ignored, and what's already been a long economic cycle just stretches on into the indefinite future. As we're going to see later, the picture becomes a bit more nuanced once we start looking at how vol markets are priced, and obviously gold sends another message entirely. But I don't think it's an exaggeration to say that this strong consensus around growth and earnings forecasts completely understates the risks that the world is facing, and that the central challenge for portfolios in 2026 is to find some way to factor in these risks without simply disinvesting. Much as CEOs in Davos may want to pretend that it's fundamentals pushing up their stock prices and it's business as usual, you can see from all of the turmoil that it really isn't. Right, so if I had to sum up the first part of the presentation, markets are priced for evolution, and they should probably be pricing revolution, whether it's legal, political, or technological. That said, pricing revolution is always hard. It's liable to be discontinuous, in particular where there's a massive force suppressing the proper pricing of risk and basically pushing everything upwards. Understanding that force of money flow and how it's likely to evolve is what we're going to turn to now.